90% of millionaires in the United States built their wealth through real estate, and yet most people never buy a single investment property in their entire lives. That's not a coincidence. It's a gap, and it has a very specific cause. 9 out of 10 people who've crossed into millionaire territory got there, at least in part, because of real estate. So why aren't more of us doing it? I want to share a story because I think it explains exactly what's holding most people back. A few years ago, I had a friend, let's call her Maya. Sharp, hardworking, and she'd saved about $25,000 sitting in a savings account, earning almost nothing. She knew she should be investing it somewhere smarter. But every time she started researching real estate, she'd hit a wall of unfamiliar words. Cap rates, cash-on-cash returns, LTV ratios, syndications. And she'd close the laptop and tell herself, maybe someday when I understand it better. Someday never came. Not because Maya wasn't smart enough, but because nobody had ever sat down and explained it in plain language. That's exactly what we're going to do today. Here's what most people miss. The real barrier to real estate isn't money, it's clarity. Real estate has this reputation for being something only wealthy people or finance experts do. And that reputation keeps regular people on the sidelines while inflation quietly eats their savings. A dollar sitting in a typical savings account earning 0.5% loses purchasing power every single year to inflation running at 3 to 4%. Over a decade, you're not protecting your money, you're slowly losing it. The good news? Real estate investing is far more accessible than most people think. You don't need to be rich to start. You just need to understand the basics, and that's what we're building right now. At its core, real estate investing does one of two things, or both. It generates income while you own it, or it builds equity as the property appreciates over time. Ideally, both. The most common starting point is a rental property. You buy a home or small apartment building, rent it to tenants, and their payments cover your mortgage and expenses, hopefully with money left over. That leftover money is called cash flow, and it's the holy grail of rental investing. Here's a simple example. A $200,000 two-bedroom property with 20% down, that's $40,000. Mortgage runs around $900 a month. Add taxes, insurance, and a maintenance buffer, and total monthly expenses are roughly $1,200. Rent it for $1,600, and you're clearing $400 in cash flow every month. That's $4,800 a year from one property. But here's the part that actually surprised me the first time I ran these numbers. That $400 a month isn't even close to your full return. Your tenant is paying down your mortgage every single month, and that property is likely appreciating. U.S. real estate has historically averaged 3 to 4% annual appreciation. On a $200,000 property, that's $6,000 to $8,000 in added value every year while you sleep. Back to Maya. About 18 months after we broke all of this down, she called me. She'd bought a small duplex, a 2-unit property. She lived in one unit and rented the other. That strategy even has a name, house hacking. Her tenant's rent covered most of her mortgage. She was living nearly rent-free, building equity, and learning the landlord business from the inside, all at once. She told me the hardest part wasn't the money or the paperwork. It was just getting past the fear of the unknown. Once she understood the vocabulary and the basic math, it stopped feeling like a mysterious, exclusive club and started feeling like something she could actually do. So where do you actually start? There are 3 main entry points, and the right one depends on your situation. First, direct ownership. Buying a property yourself, like Maya did. Most control, typically the best returns, but requires a down payment of 15 to 25% for an investment property, and you're responsible for that asset. Second, REITs. Real estate investment trusts. These are companies that own income-producing real estate, and you can buy shares through a regular brokerage account, sometimes for as little as $10. REITs are required by law to pay out at least 90% of their taxable income as dividends. For people who want real estate returns without being a landlord, this is a genuinely powerful option. Third, real estate crowdfunding or syndications, platforms where you pool money with other investors to buy larger properties like apartment complexes. Some start at $500. More control usually means more responsibility. More passive options typically mean less upside. Knowing which fits your life is part of the process. Now, and this is the part most beginners learn the expensive way, let's talk about what goes wrong. Mistake 1. Underestimating expenses. New investors calculate their mortgage payment and assume that's the number. But property taxes, insurance, vacancy periods, repairs, and potential property management can easily add up to 40 to 50% of gross rent. The number that actually matters is your net operating income. Mistake 2. Buying in the wrong market. Real estate is deeply local. A property in a declining neighborhood with a shrinking job market is a completely different investment than one in a growing city with strong rental demand. Before you buy anywhere, understand local vacancy rates, rent trends, and the economy driving them. Mistake 3. Skipping the education phase. Real estate rewards the informed. Time spent learning before you buy is never wasted. It's the cheapest insurance you can get. Here's what Maya told me a year after closing on that duplex. And I think about this often. It wasn't a perfect property. It was a good enough property in a neighborhood she understood, with numbers that made sense. She pulled the trigger. She told me it was the single best financial decision she'd ever made. Not because she got rich overnight, but because it permanently changed how she thought about what was possible with money. A quick but important note: real estate investing involves real risk. Properties can decrease in value. Tenants can miss payments. Markets change. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making any financial decisions. Everyone's situation is different, and what works for one person may not be right for another. What I hope you take from today is this: real estate is learnable. The vocabulary that once felt intimidating will start to click. The math is straightforward once you see it clearly, and the barriers to entry, while real, are lower than most people assume. Here's your one action for today, and I mean do this in the next hour. Open any major brokerage app and search for one REIT. Look at its dividend yield and what properties it holds. You're not buying anything. You're just making the unfamiliar familiar. Or pull up one rental listing in your area and run the basic numbers. What's the mortgage? What does it rent for? Does it cash flow? 5 minutes. That's where every real estate investor you've ever admired actually started. If this helped you, hit like and subscribe. There's a lot more coming. Drop a comment below. Have you ever thought about getting into real estate investing? And what's been holding you back? I read every single one.